Let's ask our headline guest today, Jeffrey Gundlach. He is the CEO and CIO of DoubleLine Capital, joins us once again in an overtime exclusive interview on a pivotal Fed day. Jeffrey, welcome back. It's good to see you as always.
Good to see you, Scott. It's hard to believe that 2 months passed so quickly since we were on the last Fed meeting.
And so many things happen. Your reaction to today's decision, one in which our own Steve Leisman said the Fed out-hawked the hawks. Is that how you see it?
It's pretty hawkish. I mean, he started out just saying we're strongly committed to getting inflation to 2%. That's pretty clear. Sounded a lot like Jackson Hole. And then 6 minutes later, he said the exact same words again. And so they're very aggressive. The problem that they're going to have is that the inflation rate has gone up so much more than they expected, and they're trying to get it to drop just as fast as it went up. And the market pricing and the consensus of macroeconomists say that they're going to succeed at getting the inflation rate down to 2% fairly quickly. In fact, the trajectory that's priced in the market for the decline in inflation is actually slightly faster than the increase was from below 2% to 9.1 on the CPI. What's weird about the way the market and economists are thinking is they think that the inflation rate is going to go quickly down to 2% and then somehow magically just stop there and go dead sideways. In fact, the prediction of economists is going to stay at 2% for a couple of years after that. But the bond market is not really reacting to these inflation numbers anymore at the long end. In fact, today's post-Powell bond market action is very recessionary looking. We have that moment that I talked about in past appearances. It's here now, that moment where we have the Fed raising rates and the short end reacts to it. Rates on the 2-year Treasury are up about 5 basis points today, but the long end actually rallies. The long Treasury rates are down 8 basis points today. And so now we've arrived at that moment of the yield curve that is truly flashing red for economic problems. And of course, Jay Powell acknowledged that that's the base case. Those data points are a 50 basis point inversion from the 2-year to the 5-year, from the 2-year to the 10-year, and a 25 basis point inversion from the 5-year to the 30-year. These are really flashing recessionary signals. Jay Powell said that the unemployment rate was probably going to go, per the committee's expectations, would end the year at 4.4%. Well, a very strong indicator of recession is when the unemployment rate crosses its 12-month moving average. And the unemployment rate is at 3.7, and its 12-month moving average is at 4.07 right now. So if the Fed is right and the unemployment rate rises to 4.4 by year end, that will be a corroborative indicator of recession. Consumer sentiment is very weak as well. That looks recessionary. And so there's a lot of things out there that, and I'll just finish on one more data point, and that's the leading economic indicators, which are at 0.0 for 12 months and strongly negative if you analyze the 3 and 6 month numbers. So I read this as being recessionary. I was surprised when the stock market actually rallied during the press conference. I thought it was completely inappropriate. I think risk assets broadly are sort of going to be on their back feet for a while.
So there's a lot to unpack in what you just said, in a number of areas I'd like to go. You told me last week out in California that you worried the Fed was, in your words, oversteering, that they should just do 25. Well, I mean, obviously it appears that they're doing just the opposite of going 25, right? That they're in your territory of oversteering. I'd like you to react to a tweet by Senator Elizabeth Warren, who called what Chair Powell did another extreme interest rate hike. I've been warning that Chair Powell's Fed would throw millions of Americans out of work. I fear he's already on the path to doing so. Are you guys on the same page, you and the senator? He's doing too much in your mind?
I'm of the camp that the Fed should have done more earlier. I think it was in April or May, whenever it was, that I actually sort of facetiously advocated, because I knew it would never happen, for a 200 basis point increase at that time. And of course, the Fed has raised interest rates now, fully now by 300 basis points. And I think they should slow down, because everyone knows, the chairman said it so himself a couple of times in the presser, The monetary policy has lags that are long and variable. But we've been tightening now for a while, and the impact of these tightenings is going to accumulate into a recession. So I'm not sure I share the same rhetoric as Senator Warren, but I do think the Fed should be slowing down on these rate hikes. I think what they've got on their predictions for the rest of the year, going another, 125 basis points, up to about 4.25%. I think that is. I don't think they're going to be able to pull that off. I think the economy is going to be showing signs of weakening. So I do think the unemployment rate is going to go up, and I do think we're headed to a recession. And I think the Fed should have paced this differently, but now they're so committed to this 2% that I think the odds of a recession in 2023 are very high. I mean, I would put them at 75%.
That high, wow. And they certainly don't seem to be listening to your calls for restraint. If anything, the R word they use is resolute, right? Powell himself said they have, quote, a ways to go in terms of getting to a restrictive level to put, in his words, meaningful downward pressure on inflation. Also said there isn't a painless way to get inflation behind us. It gives you an idea of what's in his mind.
Yeah, well, he also said in plain English that he wants the yield curve to have positive real interest rates at every point. So with the inflation rate, it's interesting how they like to use the PCE because it sounds more muted at about 4.5%, I guess, on the core. But we have an 8.3 CPI, we've got a core CPI at 6.3. So it might come down a bit, but to get real interest rates positive, we're talking about really a restrictive Fed funds policy. That should be really negative. If you hear the Fed chairman saying, I'm going to make real interest rates go higher, that's a sell signal for risk assets broadly. Risk assets do very badly when real interest rates are rising. And so I think we've been talking for a few months now. We've been fairly, just not very convicted so much on risk assets in the stock market. The past two appearances, I was sort of neutral on stocks. I think at this point you have to be looking for a down leg. And I think the S&P 500 should be probably more like 3,400 rather than 3,800 right now. And if things get really bad, the S&P 500 could drop all the way down to the breakout point that led to the huge rally the last couple of years ago. That's down around 3,000. So the thing about stocks is they started this year overvalued by all historic metrics, but they were cheap to bonds unbelievably, as overvalued as they were versus their own internal history. But that's totally changed. The bond market has sold off a lot. The Fed has raised rates. The two-year Treasury is up about 400 basis points almost over the past year and a couple of months. And spreads have widened in credit products like junk bonds, investment-grade corporates, just in all non-Treasury securities. And so now it's just the opposite of where we started the year. Stocks are certainly less overvalued than they were, but they're overvalued right now compared to a bond portfolio strategy. It is quite easy for investors, in my opinion, to make, in a very low-risk way, returns that might be high single digits from almost no-risk securities in the bond market. I'm talking about floating-rate bank loans, and not the riskiest ones, the ones that are more sort of a double B type of a rating. These have spreads against short-term interest rates. So as the Fed raises the short-term interest rate, the coupon, the interest payments from those bank loans go up 1 for 1. And so now that the short rate is getting up there, you put that spread on, and as the Fed's going to actually follow their dot plots, you might be looking at a coupon spread that gets to a yield of 7.5 or 8%. And these are securities that are very unlikely to suffer defaults. They might suffer price declines when risk assets go down, and that's already happened, which is another bonus, because these are securities that might be down at about 95 cents on the dollar, and they have every inclination in the fullness of time to go back to 100. So you might be looking at something that can give you for the next 2 years 10% in a very low risk way. Now, if you want to go and get aggressive, you can buy credit funds. So there are closed-end funds. Many of them are trading at discounts, which is another bonus. And many of these funds have coupon payouts of around 9%, but their NAVs are down. And so you get an income flow that's around 10%, and the chance for price gains is extremely high looking forward a couple of years. Yes, the prices can go down. just like the prices of stocks can go down. But the volatility of those types of funds is probably less than that of the S&P 500. And the potential for returns of 20% per annum for the next 2 or 3 years are plausible, because these are securities that start out life at 100 cents on the dollar, and many of them now on average are down at 70, because rates are up hundreds of basis points, spreads have widened, credit has done badly, and so you have a prospect for returns that are probably as good as you can possibly dream of from the equity market, but the current payout is so much higher. So these dynamics have completely reversed. I have been managing bonds for 40 years, and for the last 10 years into this year, it was the worst period ever for a prolonged basis because there was no way to win. There was no yield anywhere. The Treasury market started the year at 50 basis points. How are you going to win? Well, the long bond has had a drawdown of 40% from its high close on a price basis, 40%. So we've had total repricing in the bond market, and our team, we at DoubleLine, we're actually excited because we finally have value in the bond market. And you have to go into some junk bonds, you have to go into lower reaches of investment grade credit, but you put the whole thing together, and it's really cheapened a lot.
You said it explicitly that you don't think that the Fed is going to be able to do what it thinks it can. In essence, their actual bite is not going to match their bark, or how hawkish that they talk. You also referenced that they forecast the unemployment rate to move about 1% higher from here. Steve Leisman questioned whether that was a credible projection or not. Do you think it is?
I think if it goes up 1%, it'll go up more than that. It's just like if the CPI actually drops from 9 down to 2, it's going to go negative. You can't have that type of movement and have it controlled so surgically. Just like they completely overshot on the inflation rate. You know, they wanted to get up to 4% maybe, I think secretly, but it went to 9, so it overshot massively. So I don't know. I just think that if the unemployment rate goes up 1%, it really means that we're in a recession. It's going to go up more than that. So that's kind of my view of where we are with those forecasts. I just think that the rhetoric that I'm hearing, and I heard a lot of it today on CNBC from some of the commentators, people seem to act like the economy is really strong. I even heard somebody say that the economy was going to reaccelerate here in the third quarter. I have no idea what that person's talking about. We're only 9 days left in the quarter, and GDP now keeps getting adjusted lower and lower. I think it's 0.5 at the present moment, and the data is underwhelming, to say the least. So we have zero GDP on a real basis, actually negative by a little bit in the first half. The way things stand now, we'll have zero GDP on a real basis almost certainly through the first 3 quarters, and housing is absolutely collapsing, as you would expect. I mean, housing prices are up 40% on the Case-Shiller over the last 2 years cumulatively, and the mortgage rate has gone from the high 2s into the, pretty soon it's going to be like 6.25, maybe even 6.5. So if you look at the monthly payment on the average price home, so you take the median, the average price home, the median home price and monthly payment on average started 2.5 years ago at $1,000 a month. And thanks to the price increases and thanks to the more than doubling of mortgage interest rates, it's now over $1,800. So home affordability has absolutely collapsed. And that's a big part of the economy. And also, as I mentioned before, the leading indicators, et cetera, I won't rerun through those again. But I think the economy is weaker than people think.
I was somewhat struck, and I want your opinion on this, by the Fed's inability, its ongoing inability to forecast. And the fact that Powell explicitly himself said they expected inflation to come down more than it has by now. He said it tells them they need to do more increases. They expected shelter inflation to come down more than it has. Now he thinks it's going to remain elevated for some time. Do you have any confidence in the Fed's ability, or what is your confidence, probably better asked, in the Fed's ability to forecast exactly what's happening on the ground?
I have very little confidence. The record is very poor. A year ago, there was an expectation for something like 25 or 50 basis points of rate increases this year. And, that came out of the Fed and other people. We've just blown that out of the water. inflation transitory? I don't think so. I mean, that we're coming on almost 2 years of inflation being transitory. So I always look at the market, Scott, you know that. I always say the Fed follows the 2 year. It's funny, I did a podcast yesterday and somebody asked me a question and said, we all know that the Fed determines the rate on the 2 year, but they can't determine the rate on the long end. And I stopped the questioner and I said, you've got it exactly backwards. It's the 2 year that determines what the Fed's going to do. So it's the 2 year going above 4%. Well, lo and behold, what's the Fed say they're going to do? They're going to raise rates to a 4 handle by year end. So they're following. So the Fed follows, they don't lead. Employment is a lagging indicator. The people that want to say that the economy is so strong, they're right in the present moment. They just lean on the employment picture, and that's a lagging indicator. And the leading indicators, I'll say it one more time. There is a data series called the Leading Economic Indicators, and it's almost assuredly going to go negative year over year on the next print, which is a very strong signal of recession. So I think that the Fed, I understand where Jay Powell's coming from. He's in a certain position of responsibility, and he's got to be very measured in the way he talks. And I think they sculpt their forecasts to be as easy to swallow as possible. When medicine's bad, it tastes bad. But I think their ability to forecast has been pretty much shown to be no better than anything. And the thing that's the best at forecasting is the financial markets, which have an uncanny way of doing it. Right now, I think they're forecasting recession.
You said a couple of times, Jeffrey, that you think we're going to go into a recession, that the market is flashing signs of that. There are debates going on right now as to what that recession might look like, shallow or deep. What are your expectations of that?
I think that if the Fed's slowed down on interest rate increases, it could potentially be shallow. If they follow the dot plots, I think it's going to be fairly deep. Like I said in the last segment, if the Fed is right that the unemployment rate is going to go higher by 1%, we talked about their forecasting record isn't great, but I'm really just talking about direction and magnitude. If it really goes up 1%, it's going to go up a lot more than that. So I think if they stopped raising rates at around these levels, I think maybe they could go another 50 or 75 or something. I think you might get a shallow recession because, as people have pointed out, the corporate economy is pretty good. There's still savings from the money spraying back a couple of years ago, at least at the upper middle and high end levels. So that could be a buffer. But I think if they follow that path, the bond market, I can't say this strongly enough. The bond market action of the last few days, and particularly today, is classic late cycle action. Now, one robin doesn't make a spring, and one day doesn't mean that a trend has been locked into place. But when you have the Fed raise rates and the long end rallies while the short end sells off, that is massive yield curve inversion, and we've gotten to levels which are consistent with coming recession. So I'm gonna lean pretty heavily on that, and if they invert the curve more, particularly at these rate levels that are so low. I mean, if they raise like they're saying, and the long end doesn't move, I mean, we're gonna have some pretty nasty inversion there, and that would mean a deep recession.
Well, it raises clearly the issue of when is the Fed going to know when to stop, right? That's what Leisman has been asking for the last couple of meetings, to try and get an answer to that key question. The Fed chair today saying that they have to be, quote, very confident inflation is moving down to 2% before we would consider that. That
right.
implies that they're going full bore straight ahead.
That's right. That's exactly right. They won't give a reason, because I can't blame Jay Powell. I mean, there's so many forward hypothetical scenarios. You have no idea exactly how all the variables are going to line up. So, to say like what would have to happen by March for you to stop? I mean, that's an impossible question to answer. But it's clear to me now that we're going back to my Mr. Magoo and the jalopy analogy in terms of the way the Fed's going to be acting. They keep gunning the jalopy. They're nearsighted. They don't really see that well, and they're just going to keep going until they bang into something, run into a dumpster, and that's what's going to happen. And the data it's amazing. I'll just use the housing market as a good metaphor for the entire economy. The housing market, it was like somebody flipped a light switch about three months ago. The housing market was just nonstop on fire. And then all of a sudden, it just completely dried up. And now we have obvious declines coming in terms of future housing activity. I think that's what, when he says we have to be confident, we have to be certain that we have the inflation trajectory on the right path, that means you're going to have to see some really noticeable and crystal clear signs of deceleration. We have it in the housing market. We have it, again, in some of these forward-looking economic indicators, like the leading indicators, sentiment, and so forth. But when that gets joined with more real-time economic activity deteriorating, it's going to be too late. And I suspect that, based upon the way the markets are acting, that the Fed, with all of this resolve, he said the R word is resolute from the Fed, and Jay Powell made it very clear. He cannot, we talked about painting, right? Get off the ladder and paint. And they've been painting like crazy, but they've painted themselves into a corner because they've said we will not stop until the inflation rate shows very convincing signs of easing back down to our targets. That means a deep recession for that to happen in line with their intentions. So this is where we are, and this is why we've been, it's been defensive all year. You've got the S&P down 19%. You've got emerging market equities, down 23%, probably more after today, et cetera. You got junk bonds down 14%, investment grade corporate bonds, down more than that, down like more 19% or 18%. So this has been a year for defense and capital preservation, really the last 12 months. But now there's opportunities developing, particularly on the credit side. And the truth of the matter is that when the economy slows down and the market corrects further, and I do expect the S&P to go to 3,400, maybe even 3,000, well, buy low. Those are good opportunities. They're already there in parts of the credit market.
See, I was going to ask you, when does this once in at least a decade opportunity in fixed income run out? How long does it last for?
Well, the problem with bonds in particular, and particularly when the market's illiquid, which has increasingly become, thanks to regulations and the like, you have to buy before the low. What happens in the bond market is there's buyer strikes that go on, and it feels like we've kind of been in one for a while now. And then when the sky clears up and the sun starts to shine, the market just gaps higher. So the way you invest in fixed income is you wait until the valuation looks really good, and then you start buying on a disciplined basis, because the market will probably still go lower for junk bonds, in my opinion, and for credit broadly, although probably at a lesser pace than it has been. But then once it rebounds, it just gaps up, and you can't deploy any real amount of money. We're at the level in the fixed income market where it makes sense to start averaging at today's valuations, understanding that you might be sitting on a 5% loss or something between here and maybe year end, maybe not, who knows. And then all of a sudden, it will go up 15% in a month. That's the way these things operate. Stocks, you have more liquidity, generally speaking. But I think you also have to start buying before the bottom comes in equities. Less so than fixed income, but still you have to start doing that. And I would start doing that around 3,500 on the S&P.
Well, I was going to say that if you go down to your target of 3,400 and, if your worst scenario comes to pass and we go to 3,000, you're going to have a lot of competition out there of people who say this is too good to pass up in equities. And maybe they make that switch at that point somewhat dramatically.
And it can happen really quickly. The weird thing about the equity market is it can actually rally faster than it goes down. The opposite tends to happen in the bond market. But the rallies are always sharp off of very, very cheap valuations. And we're not there yet. We are a little bit in fixed income. We're not there yet in equities. But people should not be thinking about being sellers. They should thinking about, and I hear this all the time, and I almost criticize people for saying it, but there is a moment when it's appropriate to say people should be focusing their attention on long-term investment returns at this point in time, where you're going to be looking forward, say, a few years, not a few months, because the valuations are there in fixed income, and they're probably going to get there in equities.
Sage advice. Certainly appreciate the time. As always, we'll see you the next go-round. Continues to get interesting, and that's not going away anytime soon. I look forward to our conversations in the future, Jeffrey.
I do too, Judge. Good luck, everybody out there.
All right. You be well. That's Jeffrey Gundlach.